All right. Hey, everybody. Welcome to our investors conference call. That's what I've taken to calling this. I've named it this. I didn't ask Tanner's permission, so I hope he doesn't mind. He is on the call. He's actually en route to pick up his daughter, my son, from a band concert, but he's listening in. I know everybody's probably got a lot of questions, particularly about what happened today, because that kind of stings, especially if you fast forward or backtrack rather to Friday, where we got burned as well on that particular day. Not last Friday, but the Friday before last. And so let's just talk about that particular day real quick. On that day, we got good news. Good news on the economy. We met and exceeded some numbers, and so we fully expected the market to actually rise off of those numbers based on the situation that we were in. And we were wrong. The market actually started to go down, and we could not figure out why until much later in the day. It actually kind of baffled everybody else that was playing the market, especially in the news media. And I'm not sure who just joined, but please make sure to mute your microphones, please, so we don't have any ambient noise in the background as well. But on that particular day, the market slumped on good news, couldn't figure out why. Come to find out later in the day that Russia had massed troops on the border of the Ukraine, and there was this threat of war. Okay, well, that makes sense that the markets would go down, especially if it's somebody like Russia. That was a Friday. Fully expected another bad day to happen the next day. So we get into a put on Monday, the following Monday, and what happens? That little Russian sucker said it was an exercise and sent all his people home. Okay, the markets exploded. We were in a put play, burned everybody. And it wasn't just the people on this show that it burned. It literally burned as many people that I know that are in the market, as many people as I know. And many that I don't know, because I read the comments on various blogs about how everybody got burned. Nobody saw anything like that coming. And so you just chalk that up as to that's just something that the market does to you. We said in the very beginning, the market will burn you from time to time, and there will be no warning, you know. And so we just do the absolute best that we can, but we establish some rules for ourselves so that we can win as often as possible. Well, let's fast forward to today. Here it is again. We got great news. Markets start to fall on great news. I'm in a call play. Now, I had hard, fast lines about where I could get out. I decided to get out at one of the early points to try to save as much money as possible, and it wound up being a very good decision on my part because the markets continue to fall all the way on their S&P, and I'm sharing my screen so you should be able to see this. We're looking at the S&P chart right now, and this becomes very relevant because our 10-day moving average is right here, and we started above that. But the markets began to slump, again, off of great news that came out before the market opened about the economy. all roses and sunshine. It fell below its 10. It kept falling. It kept falling. It fell all the way below its 20-day moving average. You can see that on the screen. Went halfway between our 20 and our 50, stopped and began to retrace back because it looked like some of the big boys began to put the brakes on. Now, this was not a case of big boys short selling positions to try to fake us all out. That's not what happened. In fact, they largely didn't play except for to put the brakes on key stocks or to keep it falling too quickly. So in Facebook's example, big boys were playing this. We could see it. I could see it in volume spikes because once we actually crossed back down through the 10-day, which is where we started at, we started a little bit above our 10-day moving average, a great launching point to move up from. Once we moved through that, or to that, a fight began to take place. In fact, they finally quit playing and said, okay, we'll just let it fall to the 20. As soon as they quit playing, it tanked. It actually went through the 20, and then they started pouring money into it to the tune of hundreds of millions of dollars. The big boys poured into Facebook alone to put the brakes on it and keep it from falling below its 20-day moving average. So in those instances, that's the only time the big boys play. Now, Tan and I had a conversation about this, trying to figure out what was going on, and really was it really the big boys that was doing this? I mean, we argued back and forth. We not argued, but it was an intense discussion because I just could not figure out what was going on. And then I think I figured it out. We have a timing issue going on, and we have just the simple fact of how the markets have to work in order for everybody to make money. Okay, there's two things that are happening. So in order for you to understand that, we need to be able to draw trend lines on the S&P 500. Now, in the past, we've had trend lines, but we haven't had them here recently because we had about a 5 or 6 point correction happen to the markets that threw all of those trend lines out of whack, where we went through our 50-day moving average and went all the way down to our 150-day moving average. In fact, I think we did get down to our 200-day moving average, if I remember correctly, before we began to bounce back up. In order to understand what happened today, we have to back up in history. So if you're looking at my chart on the S&P, I'm going to back up. And what I want to do is, since my previous trend lines were blown and I have to draw new trend lines, I need to look back in history to see if there's anything to go off of. Thank you for Tanner for teaching me this. He has no idea what I'm about to say right now. So I went back and found where the last time the S&P went through its 50, bounced off its 150-day moving average, and that's my first point on my trend line, and that would be October the 9th. That's where we draw our first trend line on the bottom wick for the bottom side. Okay. Now, the next place that I draw that trend line is the very next place that we went through our 150, which was on, there we go, January the 27th, on that bottom wick. That's where the 150 went, and that's where we hit resistance on the S&P when we went through the 50. So I draw a trend line between those two places. Now, when you draw a trend line off your trend tool, if you click the line, in case you're unaware, for those that are unaware, when you click the line, you get a little tool palette that comes up, and one of them at the very top says Edit. When you click Edit, you can check off two boxes. One, it says extend left, and one, it says extend right. And it will infinitely create that line off the screen. It'll just go forever, okay? And then there's a little link at the very bottom of that says set as default. So you could change your colors of your line, the line itself, and the extensions off the end. You can make them the same color. You can make them different colors. Mine's red and blue. You can extend left and extend right. I always do that. And then you can set that as a default, so the next time that you go to draw that trend line, it will do that same thing for you every time. So as I draw my trend line, I get this line. Now pay attention, here's where it gets interesting. As it extends off to the right, you will see that my trend line and your trend line, if you're following along, and I'll just give you those dates again so you can pull up your own chart and do this yourself. The first date is October the 9th, that's the wick off the bottom of the candle. The next date is January the 27th, that's the wick off the bottom of the candle. Make sure they're extended off the left and right. That's our bottom trend. Now, once we look to the right as that trend line moves off to the right, you will notice something very interesting. That line now intersects and follows our current 50-day moving average. Because the market went through such a correction, our 50-day has now moved in line to where our old 150 used to be. Now, why is that relevant? Well, all trend lines on the S&P are based on the 50-day moving average. That's your bottom line, your 50-day moving average. So if that's my bottom line now, that 50-day moving average, that's a perfect trend line to draw off of it. Now I can draw my second trend line to go across the top. So I'll click the trend line again. I get create parallel line. I'll choose that. That creates a secondary line. I'll click and hold that line and drag it up, and I want to intersect as many of those top candles on the right as I can. And I'll just zoom in a bit so we can kind of get close and maybe you can see better on the screen. I have two ways that I can draw this trend line. I can draw it right through here, which goes through all of these tops right here. Or I can draw another one, and I'll just create a third parallel line because I'm not really totally sure where my top is. And I come across these top candles right here. Well, let me delete that middle one out. Let's go to that higher trend line. I think that's our new top. And if it is our new top, well, then it looks normal. Now the last 5-6 days look like normal S&P movement within a normal trend line scenario, from a top resistance to a bottom support, our bottom support being our 50-day moving average. Now it makes total sense. So why did we choose to come down today? That involves timing, I believe. Timing, because remember, a lot of these big boys that play get an infusion of cash in the hundreds of billions of dollars, maybe $1 trillion every single Friday. They're mutual fund managers, and they get them from 401k plans that your employer is furnishing to you. You make that contribution to what happens on the stock market. So on Friday, they'll maybe get $1 trillion to play with. Why is that important? Well, if we let it slip down today, okay, and we let it slip down tomorrow till we get to our 50-day moving average, which should be the bottom side of our trend line, now they're equipped with an extra $1 trillion in liquid capital to pour into the market to make sure it does not go below the 50. The only thing that can upset the apple cart is news. What kind of news? A major disruption in the markets could be horrible jobs reports, just horrible jobs reports, or Russia actually does invade. That could disrupt the apple cart. But we have rode this line all the way up to resistance with very little movement for so long. The big boys are just not making the kind of money that they're used to. And honestly, the kind of money that they need to keep them in a job. So at some point in time, the market, even without all of this sideways movement that we've been doing, the market has to correct and go down to its 50 in order for it to breathe. So in my opinion, what happened today was just a normal correction. They just picked today because of timing so that Friday they can make sure they can bounce it off that 50. They can keep it above that 50-day moving average line. Now here's where I pause and I throw it back to Tanner. Tanner, you still listening, brother?
Yep, sure am. And then I completely concur because if you take a look, you have, and I'm looking on my iPad since I'm in my vehicle. I am parked, by the way. One of the rare times I am. But I'm looking on like March the 8th, and you see a plus sign or a cross. I think that's the date.
7th.
That kind of day, if you take a look at it, it's at the very top. We would call that a doji. It's not perfect, but you can look it up on the internet if you want to. But at the top of a trend, a doji, where it opens and closes almost exactly where, at the same spot, but you have some movement in the day, that's usually an indicator from the big boys that we're headed down. Well, what did we do the next day? We headed down to the 10-day. Now it come back up, and the big boys, it takes a while for them to sell their positions. And they don't want to sell their positions all at one time, because what happens if they start dumping their positions all at one time? Well, it causes the price of the stocks that they own to go down, and it minimizes the amount of profit that they can have. So instead, they trickle sell. They sell it off a little bit here, a little bit there, to maintain the price as high as they can possibly maintain it. So more than likely on that day, you had some trickle selling where you had the doji, and the next day. And in all truth, the final selling was on the next day. And then we had news come out. Let's see here. It was the day before. It was yesterday that caused it to fall down to the 20. But the market's been so hot, people bought in when it hit the 20. They just did. They bought in and pushed it up. And in all truth, the big boys could have decided today that, wow, okay, well, the public bought into it. Let's go ahead and make the difference between where it closed yesterday and our resistance line. However, it would be better for them to drop it to the 50. And the reason why we want it to drop to the 50 is because if we get into a call position in a very good stock, when it bounces off the 50, you're going to be able to make back everything that you've lost in the last couple of days or the last few weeks, and then some, because you're going to ride the next play coming off of the 50 unless the market tone completely changes. You're going to ride it for maybe a week or 2 weeks. And we're talking about momentum because, again, think about it. I think we talked about this before, how it's kind of like a skateboarder putting his foot on the ground to gain speed. Well, when you hit the 50 day is something that for at least the past 5 years, it has acted as support for this market. And so everybody knows it. Technical traders know it. Analysts know it. Anybody who has had any kind of experience trading in the market, they know that the 50-day is the major support line. So when it makes it to its 60 days, if you have been watching and looking for a stock that has been moving down to its own support line, man, it would be time, unless market tone, unless the news is like really bad, like for example, Russia actually does invade. So barring negative news or negative economic news, the 50-day should act as support. So that's what I'm looking for. I'm looking for tomorrow. I'm not looking to get into a play immediately. However, if we see the market go completely down to the 50 in the first 15 or 20 minutes, and my favorite stocks are at their support line as well, I am going to put more money than I've ever put into a single play in that play. And the reason why is because it is such a strong play that it's going to move in the direction that I want it to. So everybody, and I want to just encourage everyone, the fact is that over the last few weeks, you probably shouldn't have been using a whole lot of your cash unless you don't have a whole lot. And I know that that's the situation for a lot of people, and I understand that. But if you've got the ability to go in small with one contract, over the last few weeks, that's really what should have been going on. And that way you could keep your cash as dry as possible, especially with the market behaving the whole entire market was behaving like a 10 and 20-day mover, where it moves down to the 10 days and it bounces up, or it moves sideways, there's a whole lot of movement there. So it's hard enough to get into a stock that is a 10 and 20-day mover. But getting into a stock when the whole entire market's acting like a 10 and 20-day mover is all the more difficult. So just be encouraged. This is actually getting ready to act like a normal market for maybe a little while, unless, of course, it penetrates the 50-day and moves down on terrible world news. I don't really expect that to happen, but of course I'm not Putin, so I can't tell you. So the biggest thing is to watch tomorrow. If it makes it all the way to the 50-day, look to see on your stock if there is a tremendous buy-in. And when I'm talking about a tremendous buy-in, if you have a question, go look at Facebook when it hit its 20-day today.
Okay, pause right there. I'm going to pull it up on the screen for those that have it. You can also pull up your own Telechart 2000 or whatever tracking software you're using. And let's go to the 1:10 time frame, 1 o'clock, 10 minutes after 1, at least my time on the chart. And if you can see my mouse, it's right in here, and that's the 20-day moving average. It actually pierced it. It drove through it. Well, look at look at the corresponding volume spikes that are down below. We've got tremendous spikes leading up to that moment that are red, with people selling out or short selling. We really don't know. I imagine they were just selling. And then when it hit that point, you've got several consecutive large, high-volume green candle spikes. This first one starting at 505,000 shares purchased in, all the way to the last, well, that would be about right there, another 250. So anywhere from 500,000 to 250,000 shares were being purchased on Facebook in order to not only halt the descent, but pull it back off of its 20. If you look through the corresponding minutes that followed the rest of the day, you will see a couple of attempts where it's tried to go back down to its 20, and every time it did, it was met with resistance of people buying hundreds and hundreds of thousands of shares of stock to keep it above its 20-day moving average.
Right. Because if they don't keep it above its 20, it's going to fall to its 50.
The next stop's a 50.
It fall to its 50.
It would not be pretty.
Right.
It would not be pretty.
No, it wouldn't. So, and another thing that I want to point out, Jimmy, is that let's look at 2 minutes before 1.
Okay.
Where there were 641,000 shares purchased or traded in that moment. Those, okay, I've noticed this on multiple stocks when it's approaching a support line, that you have the largest number of shares traded hands before it gets there. Okay? That is two different things happening. That is the public panicking and selling. And that is the big boys standing there, because remember, the big boys are staring at each other face to face. And every single time a transaction happens where the public sells or buys a stock, it's actually a big boy standing, and I know there's computers involved, but there's big boys on the trading floor that they can see every single order that comes in, whether it's a buy or a sell order. So they can look at their screen and go, oh, the public is selling out. Okay, well, I want to buy that. I'm going to buy that. I'm going to buy that. I want to buy that. They just do that over and over and over again. And so 641,000 shares traded hands right there. Why? Because the big boys were putting the brakes on, and they were buying this stock at a very, very, very inexpensive price in comparison to what it was. Because you got to remember, 10,000 shares move a penny. How much is that?
I don't know. I suck at math.
Is it $1,000? It's a lot of money. Okay, so 1 penny movement when you're dealing with a tremendous number of shares is a lot of cash. So they're putting the brakes on, putting the brakes on, putting the brakes on, and then when it finally does hit the bottom, you see the buy-in, 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 buy-in. And we're not talking about the little itty-bitty amounts that we were seeing before during the day, because there were minutes where there was only 42,000 shares traded hands, and on Facebook, that's a small amount. So you see the buy-in, and when you see the buy-in, you go check the overall market. Okay? Why? Why do you go check the overall market? Why do you check the S&P? Because guess what? I was tempted to buy Facebook when I seen this today. All right? Now, would it have been a good buy? Sure, I'd have made $2. You know, $2 off of movement in the first, 30 minutes or 40 minutes. Now, if you're really brave, have at it. It's your money. For me, what I wanted to do was I went over to the S&P to look at what it was doing. Now, it looked like it had bottomed out too. However, I also saw it giving up a little more. It came up, it mirrored Facebook. But then I'm going, okay, I don't know whether the big boys have done this on every stock out there that makes up the S&P or not. They've certainly done it on Facebook. But my question is are they going to halt all 500 stocks from declining? Because I don't know about you, there's a lot of red out there today on all kinds of stocks, because I went through a bunch of stocks looking for whether they had met their bottom or not, whether they had met a support line or not. Well, if they haven't all met a support line or a reasonable buy-in point, there's a good possibility that the S&P is going to continue to retrace. Well, if it continues to retrace, it's more than likely going to pull whatever stock you're looking at downward. So what you do is you take a look at the S&P and you see, oh, it's retracing too, but you go out and you look at other stocks to see if they've met their bottom. Well, there's quite a few of them that haven't. So I decided I was going to wait. I wasn't going to buy Facebook right then. Why? Because I have tomorrow. I know that the S&P is probably going to retrace all the way to its 50-day. Okay? So that's why you see Facebook declining around the 3 o'clock period. And the truth is, it declined all the way from about 130 on down. And then finally, at the end of the day, you see a bunch of buying in where it made it back to the top after getting below the 20. And they closed it above the 20. That's really important. What do I expect it to do tomorrow? I expect it to retrace to the 20, which is then, if the S&P is at its 50, it is my buy point.
Okay, I would like to, one of the ways that I recoup some of my cost in all of this, and you guys have to understand, because I've spent so much time with this whole investing the right way thing, I'm actually not making any money off of photography anymore. And so that whole, what do we call it, instant alert program that we have, that's replenishing the funds that you guys are keeping the lights on at the house right now. Thank you so much. One of these days that will be different, but until then, you guys are actually feeding my family. You and Tanner, because my wife works for Tanner. He also has an in-home daycare. But anyway, so I want to give you guys a freebie, though, that are not involved with the Instant Alerts program. We did play Facebook today. It went out in the form of an alert when we got in, when we got out. I think we did a really good job of minimizing our losses on that. But I'm going to give you another one. So you've already looked at Facebook. You heard him say that he expects it to retrace back down to its 20. And you're looking for the bounce off the S&P. You're looking for the bounce off the 50-day moving average. And you want to see the bounce. You not just sit there and hesitate. You want to see that V-shaped formation. It hit the 50, and then on the minute chart, it just begins to spike up after that. Okay, that's what you want to see. And you may want to be a little bit cautious and let it continue to climb a bit before you actually buy in. Then you bounce over to your Facebook or whatever stock you're looking at, and you watch it. Well, I'm going to give you another one, and Tanner, I want you to look at this as well too, because here's a stock that has went past its 10, had ran into its 20 for a couple of days, and then today opened above its 20, but because of the momentum of the market, it actually fell down, and they put the brakes before it got to the 50. So here's a stock that has not seen its 50 in weeks. Way back January, middle part of December was the last time it was on its 50-day. Okay? So it doesn't have a repeated pattern. That means 50 days is going to be super strong because it's been so long. And so, Tanner, you look at this. The stock symbol for this is FFIV. Phonetically, that is Foxtrot, India, Victor. This is F5 Networks. They're in the NASDAQ, in the technology sector. They're not in the S&P. Take a look at that, Tanner, and give me a quick analysis if you can.
Absolutely. This is one of the stocks that I was actually looking at earlier today. It has been forever since it's been to its 50. Well, since early, January or maybe even late last year. But see, it got great earnings as well, which caused a gap late in January. So the fact that it has been riding up the way it has, I would look for it, just like I said with Facebook, even though it's not located on the S&P 500, the NASDAQ. I don't know if you noticed, you might jump over to a chart on it at some point in time, and it kind of mirrors the S&P. So does the Dow Jones. And the reason why we don't use the NASDAQ necessarily to determine bottoms is because it's not as broad-based as the S&P 500 is. So, but it really doesn't matter what market it's traded on. You can trade it through e-auction, and the biggest thing is just determine the direction of the market. And I would use the S&P for that. If tomorrow, same thing. If tomorrow, because I noticed that at least on my iPad, it's showing that it still has just a little bit of room before it gets to the 50-day exponential.
Yes.
You can correct me if I'm wrong, Jimmy. Okay, so if the overall market continues to fall to its 50, and you see FFIV falling to its 50, talk about a fabulous buy point. And you may be able to ride it. You may be able to ride it for $11 worth of movement, depending on what the rest of the market does and world news and all that other kind of stuff. But the biggest deal is it's at a great buy point. And so what you would do with FFIV is you would go look up on the internet. You would see if they've had any bad news recently about the company. I wouldn't really check blog sites because blog sites are biased. Every once in a while I'll read a post on a blog site, and the guy's saying, I want to be short this stock, or everybody should short this stock. In other words, he wants the price of the stock to go down, and he's giving all these reasons why it should go down and all of this kind of stuff, and then at the very end he'll tell you, oh, by the way, I'm short on this stock. In other words, he's giving an argument so that he can make money. So I wouldn't really look at blog sites. I would look for actual, real news from the company. And so go look for it to see if there's a reason other than the market just simply breathing that their stock is going down. If you can't find anything, that's a great buy point. So
there's only one catch to this particular stock. It is a little bit on the expensive side.
Yes.
So put it like this, with the expiration date, well, tomorrow would be 36 days to expiration, okay? That's shorter than we would typically like, but you're probably going to only ride this for a couple of days anyway. So as long as you sold off before you got to 30 days to expiration, you still have some time value. It's not going to drop too fast on you. Remember, the closer you get to expiration date, the more you're going to lose in valuation on the option that you purchase. Once you get past the 30-day time frame, it seems to really fall quickly. So you wouldn't want to hold it for more than 6 days, or you're going to start really losing the time value portion. That, with a strike price of 105, is going to cost you right around $6. That really doesn't have the intrinsic. If it falls down to its 50, that's not going to have the intrinsic value that you're looking at. So you have a couple of ways that you can look at this. You can roll the dice and break two rules. One is the time that you're buying it. One is the intrinsic value rule of about 50%. And you say, look, 105 is below my 50. If it goes below my 50, I'm selling anyway, because the next stop is the 200-day moving average, and I am not going to hold that. So if you hold fast to that rule and you can watch the stock, I would roll the dice myself. Because if you go to the next expiration date, which is in July, you're probably going to pay $1,200 to get into the trade, and that would be well, it's in July. I don't know how many days that is. I can pull it up. Do what?
It'd be a lot.
128 days. But it's probably going to cost you $1,300 to get into the thing. Do you have that? You would be buying it correctly according to our rules. So if you look at April, the 19th expiration date, that's currently 37 days to expiration. It'd be 36 tomorrow. And if you committed to yourself to say, look, I'm not going to hold this longer than 6 days, I can't afford to, and B, I'm not going to hold it beyond the 50-day moving average. I'm just, period. That is my hard, fast line in the sand. And if you adhere to those rules and even allow it to come off of the 50 a little bit before you get into it, well, then you could probably pick up that option for about $6. I just
And a
put
good
out a
rule
video.
of thumb is to let it move $1.
Yeah, there you
Move
go.
$1 off of the 50. And if you do that, yes, you've lost $1 worth of movement. But you're, well, I can't say you're guaranteed. You are, by your dollar that you're allowing it to move is insurance that it's actually moving in that direction.
That's exactly what I was fixing to say. You're insuring your position by allowing just a little bit more movement.
Mm-hmm. That's right.
All right. So I actually want to address Greg. Greg, go ahead and unmute your phone because, or whatever you're using. I want to address you because you left a Facebook post and you were really burnt today, weren't you?
I guess so. Only because I let it. I played IBM. I've been playing for 2 weeks straight now. And I had some call position this morning.
Oh man.
And normally when it starts going down, there's a bounce. So I waited for a bounce. Never happened. So I said, finally I sold. But then I shorted it too at the end of the day. So I was down overall. I'd lost 220, and then at the end of the day, I made 90. So I lost 130
Okay.
altogether. But
well, that was keeping your head about you. But let me, we've played IBM a few times, and so I want to issue just a slight correction to you. If you look at IBM and you go back and look at any of its previous peaks, you'll notice that this stock takes 4, 5, 6, 8, 10 days to turn sometimes. It never just hits its resistance line and turns down off of it. It meanders. It's a lazy turn. And so I have decided that I love IBM, but I'm not going to play it when it gets to the top of its trend line. I'm just not, because I don't know how long it's going to take to turn. Secondly, IBM, we've toyed with the idea that they would love to turn this into an uptrending stock. Well, when a stock does that, it makes erratic behavior towards the top because it's trying to form false bottoms to get more leverage to get up, and it can look differently and for each stock. And we really don't know how that's going to look in this regard. We have no experience with that. So we don't know what's going to happen. Are they just going to let it keep falling and head back down to its previous trend line? And you should be able to draw trend lines on that pretty easy and bounce it back off of that. Or are they going to let it fall back and retrace a bit, get a second wind, and move it back up to an even newer high? I don't know. And so IBM is off the map for me until I let it figure out what it's going to do. It's a stock that I will play again. You can make really good money on the upside for absolute sure. Once it makes its turn upward, it always makes it sharply, and you can run it for a week or two. But the downside and the tops are kind of off limits for me. I would move on to something else. And one of the ones that you need to consider are these 10 and 20-day movers. And I'm not sure. Have we talked about, maybe I just need to do just a set tutorial about what a 10 and 20-day mover is, what it looks like on the chart, and exactly how you're supposed to play them. One of the things that I saw on the Facebook thing, I think Terry Burns mentioned this, was we broke a rule by getting into Facebook so early in the day. Yes, we did. However, in my most recent video, I said you can break a rule anytime that you can justify it. If you can find a reason to justify breaking the rule, you can break it. And the truth is this amateur hour, that rule is we don't play an amateur hour, is not really an hour anymore. Well, it's more like 20 to 30 minutes. Because, see, way back in the day, we didn't have access to all this software and could see markets real time like we can do now. We didn't have access to them. And so you would have to wait an hour before all of that caught up, and you were actually looking at 15, 20, 30 minutes past tense. You weren't looking at things live. You were looking at things that happened a half hour ago. So you had to wait an hour just to see what happened 30 minutes ago. You know, it was, so that's where amateur hour came from. That's where its roots came from. Well, now I can see things real time. Okay, so now you still have to wait for all the keying that happens from overnight trading and pre-market trading to go in, and you'll see lots of volatile movement on a stock at the open, lots of volume, heavy spikes up, turnaround, heavy spike down, and then right back up again. It's just crazy in that first 10, 15, 20 minutes. So if you can wait 30 minutes, it's really more like amateur half hour. I really honestly think. Also, you have to play a stock by how that stock is played. We're looking at Facebook bouncing off its 10-day moving average. That's the play. When does it do that? Well, it did it within the first 30 minutes. That's when I play it. So it's not really breaking a rule. That's just how that stock is played. IBM, on its upside of its trend, when it's leaving the valley and headed to its next peak, you probably play IBM into a call position within the first 30 minutes, because if you don't, you've missed your movement. It's going to make its movement on its upside. It'll make its movement within its first hour, and then it's done for the day. So if you wait an hour, you've totally missed it. So you have to play this stock based on how the big boy plays the stock. Okay, every one of these stocks that's being controlled by big boys, people with trillions of dollars worth of assets and the ability to manipulate that pattern and create that pattern, that's real people that have, you know, personality and bad days at work and bad days at home and vice versa. And these nuances come out of who they are as a person into the trade that they're manipulating. And what I have found is I can recognize when the big boy that's controlling IBM is actually playing. My eyes are starting to see that was him or her or them. That was them. They did that. I can recognize that. When IBM is done for the day, it gives a little pattern to it. It always gives a little pattern. Whenever the person that manipulates IBM is through playing for the day, there's a little pattern that emerges that I've learned to recognize that I can't even show you right now that says, I'm done. And when you see that, I sell. Okay? And it's benefited me the last 6 times or so that we tried to play IBM. I recognized it. Even when I wasn't playing it, I was still watching the stock to see that pattern, to look for that pattern. So play the stock for the stock, because each stock has its own idiosyncrasies, little nuances from the person that's controlling it. And it's not really amateur hour. It's more like amateur 30 minutes. Tanner?
Yeah.
Do you have...
It's exactly right. And here's the thing. If you're playing it, and I'm just learning this, if you're unsure as to the direction of the overall market, wait. And we weren't unsure this morning. We thought we were absolutely sure. I mean, great economic news, nothing in world news that was just absolutely negative. And so in hindsight, we're going, okay, well, you know, here it is. It's going against us. And we're looking for reasons why it's going against us without taking into consideration that it's probably a breath for the S&P as a whole. So if you're playing off of trend lines or you're playing off of moving averages, sometimes you're going to get burned. But otherwise, you have to play the stock according to its own signature. And, I mean, this isn't something brand spanking new. This is really old. There are people laced through history that have made millions and millions of dollars playing only one stock. And
the greatest example of that is he went on to form Berkshire Hathaway.
Berkshire Hathaway. And he made millions and millions and millions of dollars off of one stock, and that was Coca-Cola. And it's just insane. But if you find a stock that moves and moves with pretty good regularity, the biggest thing with options is we just need the stock to move. We don't care which direction it moves as long as we can sit there and go, oh, it should go this way, or oh, it should go this way. But that's what he did, and I can never remember the man's name, but you guys know who I'm talking about. So just find your favorite stocks. You should have a short list. You should have a really, really short list of your favorite stocks.
And we've given you some good ones.
Them, absolutely, every single one of them that have been put on the watch list of the front page. Those are great stocks. And so just go find one and do some research on the company and get familiar with their products, or get familiar with what it is that they're doing, because then you can start making predictions as to which direction it's going to go just based off of news that's completely unrelated. So just go pick a handful and do the research and go in and start watching them on a regular basis, and before long you're going to know what the signature is of the person who's playing it, and you're going to be able to go, oh, I know what he's doing, or I know what they're doing, and you can begin to play that stock like a big boy. And that's what this is all about. We're following the tail strings, the shirt tail of the big boys. But after a while, if you follow along long enough, you know what the pattern is and can anticipate it and can be in line for it when it happens, and you're going to make a whole lot of money by doing that. So with IBM, if in fact it is going to become an uptrend, an uptrending stock, I wouldn't necessarily play it this first time around, but look and see if it bounces off of its 50-day and moves back up again to its previous high. And then once you do that, all you need is 2 bottoms and 1 top, or 2 tops and 1 bottom to draw a trend line. Now, it's stronger for an up play or an uptrending stock if you can find 2 bottoms, but you only need 2 of one or the other, the top or the bottom, in order to draw trend lines, because you can create a parallel line and drop it along the bottom and go, oh, there it is. And so if in fact it's going to turn into an uptrending stock, I would look to see if it bounces off of the 50-day moving average and starts moving up. So that's how
that would be a good launching point for another run up for a bit.
Absolutely, and if it's going to do that, then it's going to break this previous cycle where it goes all the way down to 172.19 or somewhere really close to that, and that would be what I would be looking for, because all you're doing is looking for a stock, either a previous pattern or it's making a new pattern, and you're constantly looking at that as the possibilities. Is it an old pattern? Is it a new pattern? If it's a new pattern, okay, well, how many times has it done it? And if it's done it once, then that's a pretty reliable pattern. If it's done it twice, that's a great pattern. If it's done it 3, 4 times, then I'm going to be standing back and going, okay, well, stocks usually don't keep the same pattern for more than 3 or 4 times. So I'm going to go, okay, well, I want to see what it does now, because it usually is going to break up or break down, one or the other, after 3 or 4 times, especially on the 5th time. I wouldn't play a stock 5 times in a row on an up play, bouncing off the 50-day. And the reason why is because it's liable to break its pattern. So just get familiar with stocks, get familiar with your handful of stocks, and use the tools that the website has given you in order to pick good trades. We're going to have some more updates about picking good trades pretty soon. And also, Jimmy, I don't know, can I talk about VRX for a few minutes?
Sure.
About what happened to me and what I learned out of it, because I spent $1,500, and I choose to say that because the life lesson and the lessons about trading that I learned they need to be worth at least $1,500 because that's what I lost on the trade. And I believe, you know, when you lose money, the whole idea is to go back and look at it without emotion. Look at it, you know, from an outsider's point of view, not somebody who just lost money, but look at it objectively and look and see what you did wrong or you could have done differently or could have seen or whatever. Just go break down your trades that you lost money on, because if I lose money, I need that to make me money later. Okay, so I bought into a call position. Let's see here. Goodness,
On
the third, the fourth. On the fourth.
the 4th or the 6th?
Hold on.
The 5th. It was the
It
5th or
was,
6th.
Yeah, okay.
It was the 6th.
Okay. So it was the 6th. Let me see here, because I'm trying to blow it up here on the iPad. 3rd, 4th, 5th, 6th. No, actually, no. I bought it 2 days before that, Jimmy, because I had seen that little doji there where it had moved down, and then I bought it right there when it come above the 10-day because I expected it to move up from the 20. The previous day, I expected it to move up throughout the day, and so I bought it on that day.
What was the date on that?
The date was it was the 4th or 5th a weekend. Maybe it was. Maybe that's why I'm having a dip. It's the green after the 3rd. It's terrible doing it this way. So count 3rd and then the next day. That's
Okay, that was a Tuesday.
Okay, so I bought it on a Tuesday then. And I bought it right there because we had really good market tone, expecting everything to go up. We hadn't yet decided that the S&P had made a top, okay, for a trend. And then the next day, my sellout point that I had picked was the 20-day moving average. In other words, I picked my sellout point if it moved against me before I got into the trade, which is what you need to do as well. If you can't tell when you're going to sell something, whether it goes in your favor or against you, before you get into the trade, don't trade it. Because obviously, you can't look at the pattern and say, okay, well, it should do this. All right? So my sellout point was the 20-day moving average, which meant that I was risking actually $600. So I knew that if it went against me, I was going to lose $600. So the first day, it opened where the previous day closed and moved down, but didn't make it to the 20-day and moved back up and closed above the 10. And I'm going, yes! That means it's probably going to go up. That was just, a second bottom. Sometimes stocks do that. So I went ahead and held it. And then the next day it opened just below where it closed, and it moved down. And I said, okay, it's moving below the 10-day. But then I saw a little buy-in, and I figured, okay, well, somebody's going to bring it back up. And I kept convincing myself that it wasn't going down. And then it gets to the 20-day, and it does the same thing. It bounces off the 20-day. I'm going, yes, I'm completely saved on this. It's just great. It's going to come back. I'm holding it. I'm doing good. I'm down $600. I'd like to make that back. And then it moved below the 20-day, and then I looked back on the 3rd and said, okay, well, that low there is my next resistance or my next support line. If it goes below that, I'm going to go ahead and sell. So you see how I've already changed my sell point. I'm convincing myself to change my sell point instead of having my sell point as a hard, fast rule. Don't do that. I'm telling you now, do not do that. If you
Discipline.
have a set point, get out. That's right. Have discipline. So what I did was I held it until it made it to the bottom of the very bottom of that day on the 3rd. It was even with it. And it meandered up, and I'm going, yes, a buy-in. It looked like a buy-in to me. And so I convinced myself to hold. However, once it got below that point, because it gave it all back, once it got below that line from the 3rd that I that I had drawn across my trading page, it began to tank so fast, it was insane. I literally lost the bulk of my money in 3.5 minutes. And because I had broken my rule, my own rule of when I was going to sell out, it was dropping so fast, and I actually did a market order to sell, okay, which I don't normally do because it leaves it in somebody else's hands what I'm going to make. However, it was moving so fast, I'm going, I got to get out of this, and I really don't care what I get out of it for, as long as I don't lose everything I've got invested in this thing. So I did a market order to sell. I got out of it. I wasn't upset, okay, thank goodness. I wasn't upset, but I felt extremely sick at my stomach, like I needed to vomit, okay? Was I beside myself? No. Was I yelling at God? No, I wasn't doing any of those things. I'm going, what in the world just happened? However, take a look. It went all the way down to its 50 day. But because I broke my rule about selling it at the 20, I was in no position emotionally to make a decision to buy back in on a call. Had I sold it to 20, I would have been in a position mentally, emotionally, spiritually, whatever you want to say. I would have been in a position where I could have bought in on a call when it hit the 50 and made most of the money back that I had lost having it drop to the 20. Okay? And then I could have sold it even on that day and went, yeah, I made most of my money back. And then if you take a look at it, the next day it dropped all the way down to the 50 again. But I was still messed up about the fact that I broke my own rule. So even when it did that, went back down to the 50 the next day, I didn't buy in again. And look at what kind of movement I could have had on that day. I could have made every single dime back that I had lost. But because I broke my rule, emotions got in the way of me doing what I know I should have done. So, set hard, fast rules. For example, get in points, sell out points, especially sell out points. There's a reason why you determine your sellout point, whether it goes against you or it goes for you, so that you can take the emotions off the table. And then, when your stock, if it's going against you, when your stock begins to behave normally again, what you expect to be normal, you can buy back in. So, losses are losses. You need to call them expenses. They don't sound as bad that way. And if you set it up as a business, a loss is just that. It's a business expense. Okay? So you don't pay taxes on it. Thank you, Jesus. And because I don't want to pay taxes on that $1,500 that I lost. But have hard, fast rules, especially get out points. And if your stock does what it's not supposed to do, sell out of it. Does that mean that you stop watching it? By no means. Look at how much money could have been made if I'd have sold out at the 20 and bought back in at the 50. So, I want to encourage you. If you've had some losses, Keep your head up. Learn from the decisions that have been made. Learn how to be a better trader, because in all truth, there's nobody who doesn't lose money. No one. Somebody is losing money every time that somebody is making money. Okay? It just happened to be my turn. So here's the thing that I want. What's that?
I was going to say I don't feel so bad about my IBM loss today, then.
No, let me encourage you. Let me encourage you specifically, Greg.
Yeah,
So
I stayed tight and watched it, and kept my head as well as I could, and then that's when I decided, all right, let's go in for a short.
I think, first of all, I think you were crazy for playing a stock. And you know why? Because it's in a position now where we're not really certain as to what it's going to do. Okay, so that's why I quit playing it for now. I'm going to play it again, I promise. Okay, I love that stock. It's like one of my favorites.
I'll keep playing it, I know.
Let me encourage you about what you did right. When you bought into a call position and you got suckered into that, whether it was them doing it to you or you doing it to you or a combination of the big boys and you doing it to you, you got suckered in. And when you got suckered in and said, okay, I need to get out, you got out. And you said, I'm not going to panic. I'm not going to walk around all pissed off. I'm not going to go pick up a bottle and get drunk in the living room, wait for my wife to come home. What I'm going to do is watch it, because I'm going to see if it tapers towards the end. If it does, I'm going to get it on a put play and try to get some of my money back. And that's what you did. You minimized some of your losses. And that takes it takes an understanding of the market. It takes an understanding of that particular stock. You've been watching the stock a lot for a long time, so you've understood some things about it, and only careful observation will teach you those things. And you kept your head about you so that you could make that kind of intelligent decision in order to recoup some of your losses. So you did really good. You really did.
Yeah. I've been bearish on this thing. I've always played the drop. I've never really rode the up. And this morning, I'm like, you know what? I'm going to do this because of the news, and everyone was like, okay, we're going to grind higher now. So I went in to go up this morning. As soon as I did it just went the other way. Right away. But because that's only how I do it. I wait for it to go up, and then it will start throwing little patterns and stuff, and that's when I know it's going to go down, and I ride the downside.
Well, to recap this, I know that there is I know there's some uncertainty out there with Ukraine, and that could very well develop into something that seriously affects the markets. But I don't believe that's the reason we fell today. Additionally, you may have read in the headlines that China missed its numbers for projections on their industrial productivity. They were projected to do 9 point something. Instead, they did 8 point something. They missed it by a point. Let me tell you something. When your industrial production for your country is at 8.5%, that is a good freaking thing. Okay, so don't believe the hype that that's the reason it fell. It's not. This was a purely technical-driven move, because it just needed to happen in order for it to have a normal functioning and breathing market. Now, you know me. I wish we could get the bear market underway. I would love for the real correction to take place, but that's not what this is. That's not what this is, unfortunately.
Unfortunately.
All right,
it would
so
be better trading if it was.
You ain't never lied. So before I close this off, I want to give anybody else the opportunity to say anything. Catherine, you got anything to say? I always love hearing you.
If she doesn't,
well, I do. I know. Well, it was a bad day for me because I was in IBM too, so I'm in the loser lounge. But I know.
I'm sorry, I'm laughing, but I like it.
I'm not like in the loser lounge like you, as bad as you are. God.
Tanner's off in the corner by himself, and I'm.
But you know, I did like what you say about having those get out points and really sticking with them, because I don't, and I think that I'll just ride it out, and I'm just, it's going to go up, 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 and I'm watching, you know, the trend lines and the screen, and you know, you really do have to have when and be strict about it. And I'm not that strict, and that's why I lost money today. Pooh.
Well,
But
here's the difference. If you want to buy stock, buying stock is a buy and hold type of thing. And one of these days, we're actually going to have a class on doing covered calls and stuff like that, which when we get back into a brand spanking new bull market, we're going to actually encourage people to buy stock. Okay?
I did
Hopefully
buy
we
the
all have
option.
the
I bought
money
the IBM option last
Right.
week, actually.
Well, whenever you're doing options are always a timing thing, and that's the reason why. That's the reason why we have to have hard, fast rules on when we're going to get out. And so, because here's I
And
have
actually
had this
follow through
discussion
with
a
them.
friend. That's exactly right. Why would you give up $6 of additional movement on something that's going to go down in volume or in value when you could instead, if you know it's going down there, because once it passes the 20, where's it going? It's going to the 50. It may take it a few days, but it's going to go there. So unless you get a buyback in, which then if you get a buyback in, if they drive it back up and it's just a temporary move of beyond below the 20, we can turn around and buy it again. That's the nicest part about it, without having to carry around the uncertainty. Like with VRX, if VRX would have gone down to that one horizontal line from the third and bounced up off of it and got above the 20 and the overall market was doing the same thing, I could have bought back in again pretty close to the same amount of money.
So basically you're
that
saying
I had
if
already.
you're losing, once it goes past your point or you have your sellout point, if you're losing, it's okay, just sell it and buy back in.
That's exactly. Well, don't buy back in immediately because
No, but
obviously
I mean,
if it's continuing to go down, then you're going to lose again. But if it goes back up above that line, say within the next hour and a half or 2 hours or the next day, obviously buy it again. But you didn't have to go through the uncertainty that happened in the meantime. And you keep your emotions from getting sideways in any way, shape, or form by doing it that way. Because playing
I need to jump in.
Emotional game. Go ahead.
Well, we're talking about this, but what you're talking about is specifically oriented primarily to these what we call 20-day moving stocks. They're following their 20-day moving average. It's a little bit different if it's like a rolling stock or if it was a kiss goodbye. Things are different for different types of plays. And primarily, we're talking about Facebook, VRX. Those are 20-day movers. IBM is a completely different animal. It's completely different. So I just wanted to make sure, in case there were some new people listening that didn't understand that difference.
That's right. So you got your hard, fast point, and then if it moves back to your buy point, you buy it again and go, okay, well, it's obviously it's done with its little thing that it's doing down there below the 20. And so since it's back above the 20 and the overall market's headed up and this stock looks like it's headed up, okay, well, I'm buying back in.
I think I just live on the hope that it's going to turn around because, well, not necessarily all the time, but there was no bad news at the time. Everything was actually looking good, and the market, it was bizarre, you have to say, that the market was going down, and there wasn't really any bad news or anything like that. So I decided to hold on to it. That's why.
Yep.
I thought it would turn
totally
around.
Understand. I understand the logic, and I also understand the hope. And I don't fault anybody for having those. But if the only thing that you've got is hope, and you don't have anything else to hang your hat on, especially when you're trading options, just go ahead and do what you predetermined to do. And
I think you stated, Tanner, that hope was for church and it is not for the stock market.
No, the stock market, you shouldn't put hope in the stock market at all.
There's no hope.
You better. Sorry. But, hey, But like I said, if you're a buy and holder, then you shouldn't be playing options. Okay? There's no room for buying and holding only on hope, because you're going to get burned more times than not. But if you can stand there and make an argument for what you're doing, okay, justifiable argument, not one that's built on emotion.
I do. I do that, but it's with myself. So, you know.
Yep.
It's just me and me talking about it.
I understand. I completely understand. But if you'll take the lesson that you got today, and if you'll learn from my lesson, from the VRX lesson that I had, then it'll save you. It's going to save you money. The whole point is lose little, win
and be
big.
a better trader.
That's exactly right. Exactly right. So have.
Well, I hope this makes me a better trader because it costs me enough.
Yeah. Well, some of the best lessons in life have a value attached to them, and it may be extremely painful for a moment, but if we'll learn from them and do something better than what our government has done or other people, learn from history. That's why I spent quite a bit of time studying, and now his name's going to come to me, Warren Buffett, the guy who focused on Coca-Cola. But if you will take history and learn from it, you don't have to go through the same lessons. It's like I had an argument with one of my friends one day because I told him, I said, "You're the kid who feels like you have to touch the fire." Well, don't touch the fire. Okay? I'm telling you now, it's hot. So it may cost you, and here's the best part about it. It only cost me $1,500. But you know what? If I wouldn't have been sitting there watching my stock, I could have lost the entire investment.
Yeah.
Okay? Now, granted, it bounced off the 50. But what guarantee did I have that it was ever going to bounce off the 50?
You didn't.
Well,
you were living on. You were hoping.
I was living on hope.
Yeah, I know.
Yeah, just don't.
I know. I was in the same boat you were driving. Yeah.
Yeah. So, and you may use a phrase, and this is a really important phrase that somebody has taught me. If you're using the words like surely, or I think it could, if you're using words like could or surely, or you're trying to convince yourself, it's probably time to hit the button to sell. If you're using,
I'm going to remember that. I will.
If you're using words like should, in other words, it should do this because of this. If you're using words like should, then that's a better position than it could, or surely it's going to. So should means that you've actually been able to place your finger on a reason.
Yeah.
And so a reason is okay, but hope is just not. So
yeah.
I'm sorry about your loss in IBM. I wish you wouldn't have lost the money.
I know, but it's okay. No one's dead. No one's dying. It's okay.
That's right.
So
you're living another day.
I'm living another day.
That's right. And if you're using good money management skills, you didn't lose everything that you got.
I didn't. I bought in call play at 660. So, I mean, I didn't lose like a lot. I got in at a good buy point, I think. Anyways.
Very good.
And so, yeah, it wasn't that bad.
All right.
So
that's awesome.
What's going to happen tomorrow?
Because you seem to have comedy.
I know. I am. I'm a comedian. I don't even know what I'm doing here. I need to go straight to Los Angeles and open my own club at the comedy club.
Comedy club. Very good.
I know. I'm starring myself.
Yeah.
And then we could all do a phone-in.
Yeah, exactly. So what's going to happen tomorrow? tomorrow, I expect, this is just what I expect, and I could be totally wrong, but I expect it to continue its retracement down to the 50, the S&P 500. And when it does, I expect to get myself into a call position, as long as market tone isn't like really, really, really bad. And so look for news and look.
What about
for,
holding stuff over the weekend?
Over the weekend, I don't have a problem. I don't have a problem with that at all. And here's the
Because
reason.
like all that Ukraine stuff, they're supposed to have some meeting on Sunday, and it's supposed to be Monday.
right.
Yeah, I'm gonna have to respectfully disagree with my brother.
Okay, all right, go ahead.
And right now, and you agree with this, we are at the end of a bull market. We just are. How long it's going to take to kill this thing off, I'm not certain. But for sure, we're at the end of a bull market. And one thing that we've noticed is the big boys are very cautious about what they allow to happen, because they feel like it's they're at the edge of losing this bull, and they want to keep it as live for as long as possible, because they don't make money off of puts and calls. They don't make money unless they buy stock. They buy and sell. They buy low, sell high. That is their strategy. That's all that they do. Okay, so they don't exercise any of these other types of trades that we probably haven't even talked about on the show yet. So because of that, and because the market is so compressed and stressed right now, and because there is pending uncertainty in geopolitical environments like Russia and the Ukraine, my advice right now is to not hold over the weekend unless you just have to. If you get into a trade and it goes sideways on you, you may feel like you have to. But if you can avoid it, I would. I would play it Monday through Friday, and until we get into a new bull market, that's how I would play it, Monday through Friday.
Yeah. Because you never know what's going to happen.
I have a question, and also I want you to look at a chart if we got time.
Sure.
Well, the question is about getting flagged for day trading. Do we know what happens if you get flagged? Do you get suspended? Does your account get suspended?
No. Well, it depends. It depends on who it is. And as I understand it from eOption, when I asked them, and Tanner may have gotten a different answer from the person he talked to, when you're spending your money, and I got into Facebook today. I sold out of Facebook today. Now those funds, which were $1,100 worth of funds, are unsettled funds. I can't spend that money again until tomorrow, once they've become settled. If I try to spend that money, I'll get a message that says, okay, we're not going to let you, we'll let you do this, but you have to stay in this position for 24 hours. They'll actually flag that up on the screen.
Yeah, the good faith thing or fee or whatever.
Good faith, that's right.
Right, and that is to also ensure that you don't engage in too many transactions. Now, as I understand it, you can only do 5 in and out transactions in a week, Tanner?
Yes.
So
And
that's one per day.
And that's when they actually do follow through on suspending the account. And so you want to avoid doing that, because ultimately, okay, they say that they put that message up there, and then the stock starts to tank, and you try to sell it. Well, now you're in all kinds of trouble.
Yeah, no, I've seen the good faith. I've seen that warning, but for today, I'll tell you exactly what I did today. And I've been doing this for days on IBM. I bought in this morning. Right in the bell, I bought one contract, and then it started to go up, and then it went down, and I'm like, okay, it's pullback. I'm going to buy another one. So I bought another call, and then that's when it just started going down the rest of the day, and I sold. Looking at your chart, I sold right before the bounce. See the bounce around 1 o'clock? That bottom tail candle.
Okay.
Yeah. I sold just before that because I'm like, we're not ever going to get a bounce. but I sold sort of at the top of that, and then we did get a bounce, but you see it only bounced. So it bounced right around where I sold. So I sold out of those 2 contracts, and then it did its thing, and then I noticed that it looked like it was going to just head down to the 50-day on the daily chart. So that's when I said, okay, I'm going to do a put. When I did a put play on the second bounce, and then wrote it down to the bottom, and then as it turned, that's when I got out of it towards the end of the day, and that's when I made up some of my money. So I bought 2 contracts in the morning separately, 1 and 1, sold both together, and then bought additional puts in the late
Okay, so then you're really only gauged in 2 transactions. You bought a call, that's 1 transaction. You bought another call. That's not the same thing as selling in and out. That's totally okay.
Okay.
Then you sold both of so that's considered a 1.
Okay.
Well, it's considered a 1 when you sold both of those. Then you turn around and went into a put. That's your second transaction.
Okay, so then the selling of the put's not a 3rd transaction. It's still considered the same.
Yes.
Yes.
So you need to so brother, you need to slow down. You need to slow your roll. You need to slow your roll.
But see, I wasn't playing with any unsettled money or anything. When I looked at my account, I had limited funds. So what I did was I went into the March puts, and I literally bought the puts today that were expiring tomorrow. I knew I was going to sell them, and I knew that, well, I guess I'm not a magician or nothing. I just felt like we were going to go down, and we did, and I decided when to get out, and I got out. And, I couldn't have bought a put that had several months or even several weeks on it. I didn't have enough money. I bought put plays that were worth $1. I bought 3 of them, and then I sold them for $1.30.
The question that I've got, were you using the same funds for each one of the transactions?
No.
No? Okay. If you're not using the same, see, you get flagged when you start using the same funds for.
No, yeah, it was the same funds because I had, we'll just say I had $900 something available at the beginning of the day. I used in the first.
No, you said that you did not use any unsettled funds. That's what you said.
Right. That's what you said.
No, I used
so you
all settled funds. Sorry. No, yeah, everything was settled. It was fine. I had available money in the morning. It was $900 something. We'll just say that.
Right.
And the 2, actually I wrote down the 2 call plays were like 520. Is what they totaled after I bought both of them. I sold them for 3. So then I ended up with like a little over $300 was money that was available to me, and that's when I bought the puts. And then I sold them. So I used all good money. I didn't have any unsettled money.
Okay.
I've seen that good faith thing, and I don't do that. I don't do the good faith thing because if it goes the wrong way, and then I'm really screwed. I mean, I take chances, but I don't go that chancy.
Right.
So, but anyway, I guess. What's that?
What ultimately happens? I was going to explain what they do. E-option. If you actually do get flagged for day trading, and you break the rules, and they actually freeze your account, they'll freeze it until you have $25,000 available to trade with. Okay, so it's something that we want to avoid if at all possible.
Well, they also said, they told me, Tanner, that before you got to that point, you would get a warning.
Yes, you're going to get a warning.
I haven't got any warnings or anything, but if they freeze my account, how am I going to trade and make $25,000?
Well, and I hope this doesn't happen to anybody who's listening, but you just have to pull your money out and start from scratch.
Okay, that's in the plan anyhow. Right now I'm doing a personal account, and I will be switching soon to the
very good,
all that jazz. But so okay, that was the question. My chart was Verizon. Jimmy, if you want to throw that up.
Is it VZ?
Yeah, sorry, VZ. Look at the daily.
Okay.
All
right.
From what I have drawn on my trend lines, you can probably see that we're at the bottom trend. and we've headed that down. So I was looking for a turn if we have the the overall market tone for tomorrow to still be good. And I actually I have my trend line the other way. See, from September towards the left of your screen. I don't have mine angled that way. I have mine. It almost
Okay, you can't do that. Well, okay.
If it'll form like a wedge if you do a bottom and then.
You have to form your trend lines from recent activity, and to go all the way back to September is not recent. Now, can you still reference that previous low back in September as to be a potential bottom for you? Yes, you can. Okay, and so for that, I would just grab my H-line tool, my horizontal line tool, and I would just drag it across there so you know where it is. Okay, and then but this is how I would draw the trend on the current flow. We should meander our way down until we get down to this point. Now, what happens when we hit that previous low of roughly $45 and 45 even roughly? I don't know. It will hit resistance. You will see it hit resistance. Will it go lower than that? It absolutely could. But that's probably week down the road maybe before you get to that point.
Still think it's a little early.
Yes. Now, this is a downtrending stock. So are you only getting into put plays, or are you only getting into call plays? Because the rule of thumb that we like to follow is if we're in an uptrending market, and we're still in an uptrending market, despite what this day has done, we're in an uptrending market, you only want to be looking at call plays with uptrending stocks. This is a downtrending stock.
Yeah, I was looking for...
I would be nervous playing this because the market going the opposite direction from your play is dangerous.
I was looking at it for a call, actually.
Okay, I wouldn't get in the call yet until it got to the bottom of its trend line.
Okay.
And truthfully, okay, to go from, just look at this point, that's roughly $46. To get to its 50, right there is 47. Okay, to move $1.82, it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days to move $1.82. Took 12 days to move $1.82. So the question I have for you is this really the stock you want to be looking at?
I don't know. But that's that one trend line. What about the other candles when it took 2 days to go those points? I mean, okay. I see your argument.
This one took only 2 days, but what is its habit? Does it typically take just 2 days to get to it? No, it takes anywhere from 3 to 12.
Yeah. Well, the prices are cheap too. You can get. I think I was just looking at it. May for under $2. So I don't know. My thought was to just get one if we still have the and just kind of let it sit and ride up. I was going to sit on my money in it and not be able to do anything for what could be 10 or 12 days.
I would wait a few days until it got to the bottom of its trend line, which should be it could do that tomorrow, but it'll be right around the $45 price range, 45 even. And if you wanted to invest in a long-term call position until it got to that trend line, meaning you don't buy one of these short-term going to expire in 37 days.
Yeah, no.
You turn around and buy something that's going to expire in 75 days. Okay? And then you can afford to hold it despite any sideways movement that may occur. And it's got a history of it occurring, sideways movement. So it could make it in 2 or 3 days, or it could take 2 weeks, in which case, even if it took 3 days, do you know how many stocks I can pull out of my rear end right now that's going to move $2 in a day?
I don't know. How big's your rear end? Okay.
That was good. Touche,
cool.
dude.
That's cool. I get it. I just I didn't look at that, how it would take 10, 12 day. I just saw it had that up and
That's
down
the
pattern,
first thing that I was guilty of.
and it was down
Was
at the
was
bottom.
as Tanner was trying to teach me these things, I'd say, "Hey, look, I found a stock." And he'd go look at it, and he'd see the pattern. He's like, "Congratulations, Jimmy, you found a pattern." And then he'd start poking holes in all my balloons, man. And one of the first ones he'd poke holes is how long does it take to get to the top of its trend?
Yeah, 8 months.
Okay, and how much movement is that?
Okay, cool. All right. One other thing, if we jump back over to Facebook, I want to see something. I know you kind of told us what to be looking for tomorrow, and do a 5-minute chart if you could.
Okay.
This is how I watch, because I watch for turns. The candle there around 1 o'clock, that buy-in, the bottom tail.
Okay. We call that a hammer.
Yeah, that should be something we kind of look for if we start to go down tomorrow and hit that turning point. Is that like an indicator that, okay, it's starting to turn?
That's a very good spot, because what we find is a lot of times at the turning point, you will see long wicks off the bottom indicating pressure to push it up.
Okay. And then for me, confirmation for me would be 2 consecutive candles closing above to say, okay, we're going to continue higher. Is that feasible, or does that make sense?
Above what?
Above where it had turned and closed, and you have another 5-minute candle that went up and closed, and then the second would be going up and close. And then you wait for
That's not a bad
can see
thing.
there.
It needs to be corresponding with volume. In this case, we have high volume.
Yeah.
And something else that Tanner likes to look at is he likes the 5. Once he's in a stock, he tends to look at the 5-minute a lot, because then our 10, our 20, and our 50, what would normally be our 10 and 20, 50-day moving average, 10, 20, and 50 moving day average. On the 5-minute chart, it's 10 times 5. So it's the 50-minute, 20 would be 20 times, whatever. They become also lines of resistance, and so you'll see them bounce and catch up to each other. And when it meets, for instance, if it was above the 50, okay, it'd move up a little bit, then it'd kind of move sideways on the 5-minute chart until what would normally be the 50-day moving average, but it's on the 5-minute chart, hits it, and then it catches a new launch off of that up a little bit, and then it rides for a little bit, waiting for the 50 to catch up to it. He notices that happens a lot. It'll also do it on the minute chart. I bounce back and forth between the 1 and the 5. Tanner likes the 5 a lot. But your turn needs to always correspond with volume, correspond with volume. It's not true on a put play. On put play, when you're looking for the sell-off, they may not look like a large volume sell-off like we see on the chart right here. It could look under average volume, and it starts tapering down. It's from people selling short selling the position in order to do it. So when they're short selling the position, you won't see high volume. You'll only see high volume if they're selling that sucker, not short selling. Does that make sense?
If the public is selling it.
Yeah, if the public is selling it, you'll have volume. If you have a day trader or a big boy short selling it, you may not see that volume.
Now let's look at the 5-minute chart on Facebook again, because I'm going to point this out again, because we pointed it out on the 1-minute chart. But take a look at the 5-minute segment just after 1 o'clock, and look at the volume. That's 2 things happening. That's the public selling out because they've lost hope in their stock, and they're going, oh no, I'm losing so much money. And that's the big boys buying it. And then the next candle where it makes the hammer, see how it's not as much volume to make the hammer as it was to just simply put the brakes on. So that's what I've been looking for, to find the bottoms. when a stock is getting ready to turn around, especially on the 5-minute chart, I'm looking for that big long candle down, okay, and I'm looking for the really, really high volume, because that's the highest volume so far in the entire day, and it was the highest volume for the whole day. Was just applying the brakes. And so I'm looking for that, and then I'm looking for the corresponding hammer. And when I see the hammer, I'm going, yay, this is a turnaround. And then, remember my good rule of thumb is a dollar movement? Well, what does a dollar movement from the bottom of this to above the 55-minute moving average? It's $1.07. Okay? Because by the time, if I'm watching on a 1-minute chart, it may make it to the 51-minute segment, 51-minute line, and then if I shoot back over to the 5-minute chart, it's only made it to the 10 5-minute. Okay? Now, is that my best 5 points? Sure. But I can show you a ton of times when all it is a fake out. But if you let it move that whole dollar, go ahead.
Well, that's all I was going to agree with you. We're like, hey, it turned. There it is. There's the time. Wait. Where's it going? It's not going the right way.
Right. So if you're looking on the 1-minute chart and you see what looks like a bottom, this is what I do. I go to my 5-minute chart and I look at it and I go, well, it's only made it up to the 10 5-minute moving. So let's see what it does from here, because it's got to build momentum. Now, if it's really, really, really hot on the 5-minute, it's going to shoot straight through it all in a matter of 15 minutes. Well, if it does, I mean, if it starts moving up like crazy in that first 5 minutes, and it's already through the 10 5-minute and through the 20 5-minute, I'm buying. But if it's just meandering about, I'm going to wait for that dollar confirmation and go, it's at $1. Okay, well, I think I'm going to buy that. And so I'll buy in, and I'm buying insurance that it's actually a real move up and not just a day trader playing with me. Because they make false bottoms all the time. The reason why is because a false bottom is an opportunity for them to make money. Because all they're planning on doing is letting it go up for a little bit and then selling out of their position and letting it fall. So, but that's how I confirm that I'm actually at a turn. Is, does it move $1 in my favor? Is it above the 55-minute average? Or is it moving with such momentum that I know for absolute certain that the big boys are the ones that are turning it around? And that's where your volume comes in, because I don't know a single day trader who's got enough money to put $70 million into a trade. You know, so you look at the volume and you go, hey, look at that volume. That is insane.
That must be
so
Jimmy.
You know it's making. Go ahead. Oh, it must be
that must be Jimmy. 70 million in volume.
Mm-hmm. Hopefully someday.
Y'all keep laughing, because one of these days.
That's right.
No, I say the same thing. One of these days.
So, but that's what I'm really looking for in order to do my buy-in. Now, tomorrow on Facebook, if the overall market, if the S&P continues to move down, I'm going to continue to watch Facebook and go, okay, is it going to go through the 20? If it goes through the 20, I'm not buying it. Okay? I'm not buying it until it's back above the 20 and closes above the 20 and the overall market has started recovering. All right? Because otherwise,
it's effectively broken for you for a while.
That's exactly right. I have to wait and see what the stock is going to tell me it's going to do. So, and otherwise, I mean, if it breaks through the 20 and goes all the way to the 50, I'm jumping in with both feet.
What was that gap up back in late January when it hit off the 50-day?
Let's see.
That was leading up to earnings.
Okay.
And there was lots of rumors that Facebook was going to miss their earnings and it wasn't going to be very good. And you know, they had such high expectation for their mobile advertisements, and it probably wasn't going to come to fruition. And lo and behold, they announced their earnings, and yes, they did everything they said they were going to do, and they beat expectations by a lot, if I remember correctly. And that's where that gap came from. And then this stock turned from it was still a 20-day mover at that point, but it wasn't very committed. But at that point, it became committed. And if you want to know the truth, I've stated this several times to Tanner. I don't know if he agrees with me or disagrees with me. This stock, over the long term, is a $500 stock. It's another Apple-priced stock. I promise you. And they're starting to do things actually like Google's been doing. Google, they says, what are we going to do with a few $1 billion today? I know. Let's just go buy a company. And that's exactly what they did. And Facebook is doing the exact same thing. They're just buying people left and right.
It's what you can do when you have a market capitalization like what they've got. It's just insane. So, guys, I have enjoyed the conversation, but I'm going to have to jump off here, Jimmy. I know that
we need to end it.
You can answer some more questions if you want to, but I will be leaving early in the morning. So I just want to leave you guys with some parting thoughts. I want you to be blessed. I'm praying. You guys are going to learn something about me. I'm a really soft-hearted man, apparently, because I can't keep from crying. Crying about I just want people to be blessed. I want you guys to be blessed. I want this to be a success. I want you guys to be successful in trading, and I want it to change your life. And I'm just praying for you. Know that you got somebody out there praying for your success. And I appreciate you guys. I've learned a tremendous amount just by sharing what I have learned so far. Just by sharing it with you. I am an auditory learner. So anybody else out there that's an auditory learner, you know that that hearing something doesn't mean the same thing as saying it for yourself. When you say it for yourself, it becomes true, it becomes real, it becomes meaningful. And you guys have given me the opportunity to do that. Jimmy, I appreciate you. Just keep it up. Use good money management. Keep learning. And before long, we're going to be all getting together somewhere and having a blast, recounting the days where I lost $1,500 in VRX. And I'm going to put it to you this way, and this is the perspective that I'm walking away from that trade with. I hope that I am in the position someday where $1,500 is the smallest loss that I've had to bear. Because if I get to that point, there's coming a day where I'm probably going to lose $30,000 in a trade. Okay? It's just a matter of time, because if I'm trading with the amount of money that I expect to be trading with, eventually I will lose that kind of money. And it'll mean the same thing as the $1,500 did to me right now. But I know because I lost money and because of how I handled it, that when I do lose $30,000, but I'm trading with $100,000, it's going to be okay. So
just remember at the end of the day to try to get like 10,000 back. Don't.
Exactly. I like that. I agree with you completely, because see, that's the thing. One of my friends, he has lost over $300,000 trading, but he's made millions. So it's all about perspective, and it's all about good money management. And so hopefully we get to that point where we're managing our money in such a way where we could lose everything in 10 straight trades and still have money to trade with. So that's the goal. Eventually, we'll cover that. We will cover money management once we get to the point where we don't literally have to play with everything we've got in order to get into a trade. And so, but that day is coming. But guys, bless you. I appreciate you.
Thank you, Tanner. We appreciate you.
Great to see you. Well, thank you. And you guys have a great evening and a blessed day trading tomorrow.
Okay.
All right.
Later, guys.
All right.
We'll talk to y'all later.
Bye.
Okay. All right. Bye-bye.
Thank you.
The organizer has ended the session, and this call will be disconnected.